What if you could earn a steady 6% dividend by owning a piece of some of America's most iconic hotels and casinos without ever making a reservation? Could one stock really turn that dream into reality? Before diving into the numbers, it's important to understand what VICI actually is. VICI is not a traditional landlord and not a typical REIT either. It owns mission critical experiential real estate, casinos, resorts, entertainment venues, and leases them out under long term triple net leases. This means tenants pay rent, maintenance, insurance, and taxes, while VICI focuses on collecting highly predictable cash flows. Since its formation in 2017, the company has announced roughly $38 billion in investments, building one of the largest gaming and experiential real estate portfolios in the world. The company is currently available with a starting dividend yield above 6%, compared to its 5-year average of around 5%. The price to FFO ratio stands at 11.8 versus the 5-year average of 14.4 and the sector average of roughly 15. The stock is trading at $28.66, while analysts estimate a target range between $31 and $38. Based on these metrics, VICI appears to be slightly undervalued. VICI currently pays $1.80 in dividends per year, distributed quarterly. The next dividend payment will be on January 8th, and anyone who holds shares by December 17th at the latest will be eligible to receive it. The most recent dividend increase was 4%, while the 5-year average increase is 7.7%. The company has been paying and raising dividends for the past 6 years. The FFO payout ratio hovers around the 75% target year after year. Both FFO and free cash flow per share are on an upward trend, characterized by slow but steady growth. The company issues new shares every year, which is completely normal in the REIT sector. And as long as the growth in the total sales chart keeps pace, this does not pose a problem. The company's debt level is higher than ideal, likely due to increased leverage during COVID, but it has been decreasing since then, despite the high interest rate environment, which is good news, as management takes debt control seriously. The interest coverage chart has remained above the 3-point target over recent years and appears to be stabilizing again. In short, the company is currently available with a 6.28% starting dividend, which was recently increased by 4%. It holds a BBB- credit rating, and the dividend appears to be safe for now. However, the company needs to monitor its debt levels carefully and continue repayments or grow revenue faster than debt. This could be an attractive entry point for slightly more risk-tolerant investors who value a high dividend yield. If interest rates are cut, the company could benefit, and this would likely be reflected in the stock price.
Disclaimer. This video is for informational and educational purposes only. It does not constitute financial advice. Always do your own research before making any investment decisions, and never base a financial decision solely on the content of this video.
VICI's growth story is one of disciplined scaling. Since inception, adjusted EBITDA has grown nearly 4 times, reaching an annualized $3.3 billion in Q3 2025. This didn't come from reckless expansion, but from carefully structured acquisitions, tenant diversification, and balance sheet discipline. The company also achieved investment-grade ratings and joined the S&P 500 remarkably fast for a REIT, a strong signal of institutional credibility. One of the most impressive parts of the quarter is how protected the cash flows are. VICI reported 100% occupancy, 100% triple net leases, and 90% of rent backed by parent guarantees. The weighted average lease term is about 40 years, which is almost unheard of in real estate. On top of that, 79% of rent comes from SEC reporting tenants, meaning investors can actually see the financial health of the operators behind the rent payments. This quarter again highlighted why VICI performs differently from traditional net lease REITs. Around 42% of rent is CPI-linked today, and that figure climbs to 90% over the long term. In a world where inflation can suddenly reappear, this is a built-in hedge. Even better, VICI runs with extremely low overhead. G&A is just 1.6% of revenue, one of the lowest in the entire sector. The business is lean, scalable, and inflation-aware by design. Yes, gaming is still the backbone, but the portfolio has quietly evolved. VICI now owns 54 gaming properties and 39 other experiential assets across the US and Canada. It is also the largest owner of hotel rooms and privately owned convention space in America. Las Vegas remains central, with trophy assets on the Strip and exposure to mega events like Formula One, the Super Bowl ecosystem, and future MLB development. These are assets that are practically impossible to replicate today. Management made it clear that future growth will come from three engines. 1. Acquiring irreplaceable experiential real estate. 2. Providing structured financing with embedded ownership options. And 3. Partnering with tenants to fund expansions in exchange for higher rent. This quarter reinforced that VICI doesn't just buy buildings, it positions itself upstream, often securing call options or ROFRs that could turn today's loans into tomorrow's owned assets. That creates a visible long-term growth pipeline without betting the balance sheet. Since IPO, VICI has delivered a 124% total return, significantly outperforming the REIT index. Dividend investors should pay attention. VICI has raised its dividend every single year since inception, now paying $1.8 annually, with an approximately 6% yield and a targeted 75% AFFO payout ratio. Dividend growth has compounded at 6.6% annually, which is exceptional for a REIT at this size. The balance sheet remains solid. Net leverage sits around 5.0 times, right within management's target range. About 99% of debt is fixed rate, 83% is unsecured, and the weighted average maturity is over 6 years. With investment-grade ratings from all three agencies, VICI retains flexibility even if capital markets tighten again. Key positives: extremely long lease terms with inflation-linked rent escalators, 100% occupancy and rent collection even historically through crises, consistent dividend growth with a high starting yield, investment-grade balance sheet with mostly fixed-rate debt, unique, irreplaceable real estate with high barriers to entry. Key negatives: heavy exposure to the gaming and leisure industry. Growth increasingly depends on structured deals rather than pure acquisitions. High valuation sensitivity to interest rates due to REIT structure. Concentration in large tenants like Caesars and MGM. Conclusion: this quarter didn't bring flashy surprises, and that's exactly the point. VICI continues to execute a boringly excellent strategy. Protect cash flows, grow rent organically, and compound dividends over time. For long-term dividend and income investors, this report reinforces that VICI is less about short-term excitement and more about durable, inflation-resistant compounding. It's not a growth stock story. It's a cash machine story done right.
Thanks for watching, and if you found value in today's video, give it a thumbs up and consider subscribing for more smart, long-term investing ideas. Stay patient, stay consistent, and keep building your path to financial freedom. Until next time, take care and happy investing.